the conversation, the debate is pretty simple. Have we just paused or are we set to reverse? What do you think it is, Ebrahim?
So great to be back on the show. Our view is that we're only pausing and that we are very much in what you call this exhaustion phase, where a number of, I think, the more challenging trends have exhausted just as much as maybe the stabilizing forces that we've seen over the last 2 weeks or so, with rates probably finding just about a bottom, but also actually some of the more positive sentiment about maybe peak pessimism about the third COVID wave in Europe, or maybe in a place like Brazil even, also already being reflected to some degree in market prices. So we think this is probably no more than a period of consolidation, but that cyclical trade still has further to run in the coming months.
Ebrahim, within your very sophisticated notes, there's a lot of mathematics on correlations, on the linkages of asset classes. How linked and smooth are the dynamics working right now, or is it all distaff? Is it all discrete and separate?
Well, they have been somewhat unstable for quite a while, and that's in line with, I think, these, if you like, the most fundamental market trends changing. But I do think there's one correlation that is both unstable, but equally ultimately very stabilizing for broader markets, and that's between rates and risk assets. And the fact that we've seen probably the volatility of US rates top out here, that we are probably in a range for the US 10-year rate of between 150 and 175 for the time being. I think that puts us back into a world where equity prices and risk assets can resume their ascent. So it is not quite maybe a negative correlation that is reestablished there, but there is hope for the so-called risk parity trade now that US rates have probably peaked in the short term.
Ebrahim, I've seen a lot of analysts talk about the reflation trade as a monolith, basically this idea that it has been consistent throughout the past few months. It has not. The nature has changed significantly over this period of time in terms of what's getting reflated. The U.S. was the dominant reflated trade based on the economic prowess of the nation. Why is that not going to continue as the reflation trade gains traction, as you say it will?
Yes, I mean, I would highlight two, I think, changing developments over the last couple of months that are notable. One was, as you said, U.S. exceptionalism, and there our view is we've probably peaked out in the exceptional nature of that, and the rest of the world does have hope of maybe catching up somewhat, not converging, but catching up somewhat. But the other is that even in the U.S., what's happened over the last month or so is investors have decided that they are not extrapolating that exceptionalism too much further out. So if you look at US rates, US inflation expectations, if you go a couple of years out, when investors are telling you we're getting a big impulse to growth and inflation in the very short term, but further out, we might well be going back to where we were. And again, that was very important for where US rates are, and it's very important for where the US sits relative to the rest of the world. Our view is we're still in a more or less synchronous global recovery environment a few months from now.